Hello and welcome to Pro Trader Strategies Market Commentary for Monday, April the 1st. My name's Eric Wilkinson. Some of you may recognize me as a Wolfman from CNBC, Fox Business, or even Wall Street Journal for my commentary on everything from economic to geopolitical market analysis. Please keep in mind, everything we talk about in these market commentaries is not a solicitation buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies you can implement in your portfolios, but please do that in your own way. And remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with some economic data. It being a Monday, usually we don't get a whole lot of economic data, but it being April Fool's, I guess they decided to throw a plethora of economic data at us this morning. So let's get on with it without further ado. The markets are up on the equity side. And let's see if it has to do with the overnight economic data. Now, remember, when we're talking PMI, it's Purchasing Managers Index. This is the manufacturing side of the index, and the purchasing manager, the guy that's buying the raw materials to bring into the manufacturing process to produce whatever the heck they want to produce, right? So we don't know what they're producing, and we don't really care. All we care about is that they are confident, all right? So if it is above 50, that means they're confident. If it's below 50, it means they're kind of like, okay, this isn't looking too good. So that being a bad thing, obviously. And remember, we've seen France and Germany, they're the biggest manufacturing sector of the European region. They've had a couple of these numbers come in below 50. And that is on the flash estimates. Now, that is their most important economic data point for the PMI. But you know, we still can get a pretty good gauge of the economic picture from just the manufacturing PMI numbers. This isn't one of the most important ones, but I like to look at it anyway. So that's what we're going to do. All right. So anyway, we got Spanish manufacturing PMI came in at 50.9, expected to be 49.8. So they were expecting a below 50 reading again this month. Last month they had a below 50 reading, so they were expecting another one. You get three of these in a row, and that is recessionary. Now, people are going to say that needs to come from their flash PMI numbers, okay? So these three, if this was three in a row, that wouldn't hold as much weight as if it was their flash PMI, okay? So I don't want to get too ahead of ourselves here, all right? And then we've got out of Italy came in at 47.4, expected to be 47.6. So again, a reading below 50 is not good. This reading, obviously, is coming out of Italy, right? I mean, they're bankrupt. They're pretty much done. So we've seen this happen for the last 6-7 months where it's been below 50. Three in a row, like I said, you're in a recession. So French final manufacturing PMI 49.7, expected to be 49.8. Again, below 50, but this, we haven't had a reading below 50 the last 2 months. So that isn't showing necessarily recessionary trends. Now, Germany, one of the biggest manufacturing aspects of the European region, coming in at 44.1, expected to be 44.7. This is three in a row for Germany, okay, on this one. Okay, that being said, that just kind of makes us perk up a little bit. I know that their flash PMI for Italy has come in twice below 50, so I'm expecting it to happen again as well. All right, and then we got Great Britain's manufacturing PMI 55.1, much better than the expected 51.2. And then the European CPI, Consumer Price Index, flash estimate. Now, this is the most important one that we're going to be looking at for the European region. The CPI flash estimate 1.4, expected to be 1.5. They also had the core CPI, which strips out some food and energy. They're a little bit more volatile. So we strip those out and we get 0.8%, expected to be 0.9%. Both of those readings coming in below expectations is bearish for that type of reading. They want to see prices push higher because that shows demand and inflation and all of those things, right? I could care less about prices going higher. As a matter of fact, anymore, I don't know that that's a good thing to have the prices go higher. Even if there is demand there, if prices can stay low, that's not necessarily a bad thing. Here back in the United States, we got core retail sales coming in at negative -0.4%, expected to be a positive 0.4%. So really pretty dismal number there. And last month's number, though, was revised up by about 0.5%. So it was 0.9% last month. They revised that up to 1.4%. So good revision to last month's number, not making up for the wet blanket we're seeing here in the core retail sales. Core retail sales also is one of those numbers where we take out automobile sales, airplanes, and stuff like that. Therefore, it is a more it's a stronger judge because there's so many cyclical patterns with cars and automobiles and in airplanes and things of that nature. So they're stripping out the retail sales for autos. All right. And then retail sales came in at negative 0.2%, expected to be a positive 0.3%. So again, missing quite a bit there, but a revision to the last month's number kind of washes that one out because it went from 0.2% to 0.7%. So a 0.5 increase there, and we missed by 0.5 on the other one. So it's kind of a wash, but it's still not looking too good when those numbers go negative. It's just going to be in the back of everybody's mind anyway. And then we got manufacturing PMI here in the United States in the form of our most important number, and it's the ISM, Institute for Supply Management. That came in at 55.3. Again, our number is the same as theirs. Anything above 50 is expansion. We've had some pretty decent numbers coming out of that. We haven't seen any of those for the past basically over a year now in negative territory, so we aren't too worried about that one. Business inventories. This is something we've been concerned a bit about lately because we're starting to see these inventories rise in a time where they shouldn't be stockpiling inventories because there's no expectation of any kind of big move to purchase anytime soon. The economy's just not moving that fast, but these inventories are starting to build, and it came in at 0.8% and expected to be 0.4%. Construction spending coming in nicely at 1%, expected to be 0.1%, so much better move higher on that one. And then last month, we got a reading of 1.3%. They revised that up to 2.5%, so that is showing some really good strength, especially in the construction sector. Manufacturing, ISM manufacturing prices paid came in at 54.3, expected to be above 50. Last month's number did come in for those prices paid below 50, and we had two of those. Didn't get the third one this month, which is nice, thankfully for that one. And that's about it for the economic data across the pond and here in the United States. So let's talk about some stuff going on in the markets. Strength in crude oil. Now we've gotten above this Fibonacci area right here and are starting to push. We're going to go test this 200-day moving average, and I think it's going to stay in the 60s a little bit. Now that we're starting to see some of these ISM numbers, our numbers are looking pretty good. I think it can sustain a 60 handle a little bit longer. I don't want to see it push too high because then that's when we're going to start seeing a bit of a pinch to the consumer. I would rather see the consumer spending money on everything else but oil, to be quite honest, including oil, don't get me wrong. But I want that velocity of money. If everybody's spending money everywhere else, then that creates velocity of money. The little guy starts doing better. If all the money goes to one sector of the economy, then it makes the economy struggle. So that's why I like to see lower prices and all of those things, and crude oil being one of those. Like to see those prices a little bit lower. Gold futures can't hold on to that 13 handle. Sorry, I missed Friday's webinar because I was flying to Houston for a convention, so I missed on Friday. Sorry about that, but we were seeing this sell-off, and below 1300 on Thursday, it stayed there and looks to probably stay in the mid to lower. Actually, not even that. It's the lower 1300s. I don't even know if it's going to make it up into that handle anymore. I think the markets are starting to push. All right, bonds really coming off. You know, I talked about this for quite a while. Like literally, they just way overdid it to the upside, which is that's the point where we start getting involved, right? When we see this market get really overextended, the volume coming out. Meaning there's just no participation up at those levels where people are just saying, hey, I don't think it's really worth that. I'm kind of out of this trade at this point. And that's where we start to see that cover of those trades happening. So with that being said, in TLT, if you remember, I went into the TLT trade and played this to the downside as well. So we'll talk about that in a minute. But the bonds overextended to the upside. We played that pretty well and have had this market really come off quite nicely. Then we're talking about the VIX. VIX is seeing volatility come out. You know, that is a product of the markets going higher. We talk about this all the time. Markets are moving higher. Volatility has a tendency to come out. It doesn't necessarily mean it is, you know, a product of the other. Markets go up, volatility has to come out. But a lot of times that's what we start to see is when the market starts rallying, we see that volatility come out. It's just a product of fear in a sense. There's a lot more that goes into it, but if we just break it down into fear, you're not fearful when the market's going up. Most people anyway. Most retailers. All right. Dow Jones Industrial Average up another 200 points. Remember on Friday it was up 200 points. We've gapped higher today, as you can see here. Even the breakdown on the E-mini S&Ps, we'll see that whole gap higher happening overnight last night. So we're gapped higher right now. 130 points higher on the day. I would expect us to kind of get a little overextended, and we're going to need to come back and cover that gap sometime soon. I don't think it's going to take very long. Might be a day or two, but I do believe we need to cover that gap now. Looking at the NASDAQ, you can see we kind of opened up higher as well and gapped a little bit. We have almost had unabated to the upside. It feels like we did have a bit of a correction happening early morning right after the market opened, and we saw some of that economic data coming out. I think the U.S. economic data has given us another lift though. So look at the E-mini S&Ps again, gapping, but we are finding this as to be a bit of a resistance. We're going to have to keep an eye on that and make sure that we put a line in there, even if there's no Fibonacci. You know, it doesn't really coincide with the value area high too closely, but we are going to need to keep an eye on this area right here at 2861. Okay, so 2861 to 2865. Let's just call it 2865. All right, so that is going to be acting as resistance. Here's the gap higher on the open, almost unabated to the upside. Got a little bit of consolidation overnight, but economic data out of the U.S. has caused this market to rally to the highs that we're seeing now. All right, so let's get on to a couple of trades that I've done. We've talked about this before. SPY, I was playing this one to the upside. It worked out quite nicely. I went into this one. It had some decent volatility in there, if you remember. It was a few days ago. I think I started putting this trade on not too long ago. Played it to the downside, right? So, actually, sorry, it was playing this to the downside. I didn't put it on too long ago. It was a delta adjustment in my overall portfolio. If you remember, my portfolio was long deltas, which I'm not really used to very often. It was getting very long deltas. I needed to add some protection. I put that trade on at the right time for the protection. It allowed me some breathing room, right, to stay mechanical with the rest of my trades going on. This one didn't work out, but it allowed me to stay in on my long position much longer and much more comfortable. So that's why we stay mechanical with all these trades, you guys. Stay mechanical with it. Keeps your powder dry. You're able to stay in these trades longer. I did lose money on this one, but all of my other ones are working out. So let's talk about this one in particular. With SPY, I went into the April and I had bought the 279 puts in there. Now you can see I bought those 279 puts in that SPY. We got a nice big correction on this trade. Came back off, and then I was directionally wrong after that. But I needed that trade on because when we came up and tested this value area high and started rolling over, it really felt like we were going to maybe have a correction back down to the point of control, which would have really hurt my overall portfolio if I didn't have any short deltas added in there. But it allowed me to stay in these trades a little bit longer. Today we've got that pop, so I'm pulling the ripcord on it. I'm out. So in that SPY trade, it was a loser. I covered those. I paid originally for the SPY $2.46. I got out of them at $1.12. So it is a loser. But having said that, with the way that I set this trade up, and then I went into the TLT, if you remember, thinking TLT got a little bit overdone to the upside and wanted to play it to the downside. And that worked out quite nicely because in TLT, I went in there and did the April, sold the 128 calls in there. We had really high implied volatility. This was one of those products where, one of those times where we see volatility spike with the market moving higher. It's getting a little irrational. People freaked out a little bit when we started seeing this move. You know, all of a sudden, all these Fed governors are all dovish, and we got this spike in volatility. I was able to take advantage of that by selling these TLT calls in there. So I sold the 128 calls in there for originally 66 cents. I was able to buy them back today for 21 cents. Now, with my scaling and stuff like that, you guys know that when I'm buying premium, I'm using very little contracts, or not very many contracts. And then when I'm short selling or naked strategies, I'm using a little bit more quantity. So basically, the TLT trade and that SPOI trade canceled each other out quite nicely. So actually, the TLT trade made up for it a little bit more, but that was kind of a scratch on both of those. So that whole delta trade or delta adjustment trade, staying mechanical with it, looking for opportunities to keep myself in these trades longer, keep my powder dry, my brain not like spinning, all of those things help you out become a better trader, you guys. I can't explain it enough. All right, and then finally we did the Caterpillar trade. With this one, we were also doing this with a directional move, and I went into the May because I wanted to buy some premium in here, and did the May, bought the 140 calls in there originally for $3.45. Well, I was able to get out of those for $5 today, an increase of a 50% increase in my premium value, which was exactly what I was looking for. Come up and test that target that we were talking about right here, coming to the point of control. I said if it came up and started trading anywhere near my 140 calls, that was going to be the opportunity to get out for that 50% increase, right? I've beaten the probabilities. I'm out. I don't care if it sticks around. Remember, this delta trade that I did, it was about a 35 delta on that. And that means there's only about a 35% probability of me being in the money at expiration in the next, when is that? It was a May trade, so it's got to be another 40 some days. Do I want to be in there that much longer? No, I'm out. So hit my target, I'm out for that profit. And I'm sorry I really kind of ranted on today. I kind of got a little excited and overzealous on some of this stuff. But, you know, I love you guys, and I want to share all this stuff with you so that you guys can stay mechanical with me. This is how we trade, right? I've gone through it step by step, how to stay mechanical and making these things work out. So I hope you guys followed along and were able to participate. That's all I got for you guys. Other than if you can't take that, take it easy.